Good morning. This is Chair French convening the regular business meeting of the Kansas Corporation Commission for August 27th, 2026, joined by my colleagues Commissioner Keene and Commissioner Keither. On today's agenda, we have a consent agenda consisting of 14 items, and we have one discussion item, which will be an update on Southwest Power Pool activities by our Utilities Division Director, Justin Grady. But we will begin with our consent agenda. As I mentioned, it is a 14-item consent agenda. However, I have had a request from staff to remove item number 12. That is an order in docket number 26 TRAM 0472 UCR. So I will remove item number 12. So we have 13 remaining items. Commissioners, you've had the opportunity to review those 13 items. Let me ask at this time if you have any questions, beginning with Commissioner Keither
No questions, thanks.
and Commissioner Keene.
None for me either. I'd move approval of the consent agenda.
Second.
All right, we've got a motion and a second to approve the consent agenda, noting that we removed item number 12. Any further discussion on that motion? Hearing none, all in favor, please vote aye.
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 Aye. Any opposed, say no. The consent agenda is approved. With that, we will move to our one discussion item, but these discussion items are not ever quick. So we will move to that discussion item now. Mr. Grady, if you're ready, I believe you can share your screen.
Good morning, commissioners. Let's see how we can do with the screen share.
There we go.
Looks perfect.
All right, great. Let me try to move this over here. Okay, so you're seeing the screen now?
Yes,
Yes.
we do.
All right, great. Well, hey, good morning, everyone. Justin Grady, Director of the Utilities Division. I don't know why it is that every time we do this presentation, our lawn maintenance crew is outside of the KCC building, but that's the case again this morning. So hopefully you can't hear them mowing and doing their activities. We'll just go to the agenda slide here. It's a little bit of a different presentation this quarter. So I'm including everything that we normally would talk about, but this time what I did is the meeting or the materials that were covered in the RSC business meeting and the board meeting, a lot of those materials are actually in the appendix this time, and that's just because ultimately the items that were approved at the business meeting, the RSC business meeting, were not all that impactful to the state of Kansas. And you'll see there were some administrative items. There were, the RSC budget and audit were approved, but sort of, ministerial perfunctory type approvals. A lot of what was approved by the RSC this quarter related to SPP West, or the Western Balancing Authority, the Western Interconnect that was integrated into SPP earlier this year, and so that's why those materials are in the appendix. The majority of our discussion today is going to be on the items that are sort of upcoming, and also just an update on the care team activities that I serve on, and the commissioners are aware of what the care team is and what its focus is. It's a 2026 effort, all of 2026 effort to attempt to recommend to the RSC potential changes in cost allocation for transmission projects above 345 kV that are likely to come out of the 2026 ITP, Integrated Transmission Plan, as well as the anything above 345 kV that came out of the 2024 and 2025 ITPs. And also we are focused on a large load cost allocation framework and potential changes for large load that is coming onto the system. And so we'll talk quite a bit about the the CARE initiatives and the CARE effort, and where that process stands, and just what's likely to come up in the next couple of months. And then I'm also providing an update today on everything that we know at this point pertaining to the 2026 integrated transmission plan. That plan, that portfolio is not finalized yet, but we are about a month, or well, we're a couple of weeks out from getting much more. So we're a couple of weeks out from the engineering summit that was held in Denver, Colorado on July 28th and 29th. We learned some there. And then we're, 2 to 3 weeks out from having a more finalized portfolio for the 2026 ITP. So this is all getting ready to ramp up pretty extensively. And I wanted to, do my best to provide the information that I have to the commission at this time and anybody listening in. I did sort of question whether or not I should, front run SPP's presentation in terms of including this information in the 2026 ITP. But, it is what it is. I only do this once a quarter. And so maybe there may be some duplication in terms of what you hear that I report to you today and what SPP is going to talk to you about. A quick plug for those of you at home that tend to listen into these presentations. On September 8th at 10 a.m., SPP leadership staff, engineering and staff is going to come and present to the commission in a 2-hour workshop what they are seeing as the likely, probably by that point, we should have close to a final portfolio on the 2026 ITP. And then there's going to be an opportunity for questions and answers from the commissioners and senior utilities division staff as well. So that is an overview of what we're going to cover today. There are 56 slides in this deck. I ate breakfast this morning and I don't always do that. So hopefully the commissioners are settled in and in comfy chairs or whatever. If we have to end this at some point, you might have to just cut me off because there's a lot going on with SPP right now. So I did have an opportunity to send out the slides last night, and there's been no changes. So these are the items that I referred to that were covered in the business meeting. All the same information is provided that I normally provide, but all of this is in the appendix this time. Like I mentioned, these issues are really not, they're sort of administrative, almost ministerial type issues. One thing I'll mention, I guess, is that third bullet point down. You've seen that before, the planning reserve margin. This is, it has been approved. The policy was approved last quarter by the RSC and the board. This was just the implementation of the language in the business practice manual. So this was sort of ministerial. There wasn't any controversy associated with the establishment of these planning reserve margins. It's set for 2030, 2031, and 2032, and it's set to stay the same. It's set to increase in 2029 and then stay the same for those 4 years at this point. And then the rest of those issues, again, were really focused on the Western interconnect. And there were a few of them that only the Western states voted on. If you have any questions about any of that, feel free to reach out. The board meeting was on August 4th. The board did approve all of the previously recommended or approved RSC items. And then there were 3 items that I thought we would focus on and go into a little more detail on. There were 2 termination point changes from some of the 765 kV lines that were approved in the southern states, in Oklahoma and terminating in Louisiana. And there was a reevaluation of the termination point for those lines, and ultimately SPP staff recommended a change in the termination point, and ultimately the board approved that at this meeting. We'll go through a little bit of detail to talk about those. And then SPP is conducting a new study. They call it the We Expand study. It's essentially a evaluation of whether it makes economic and reliability sense to expand the size of the DC ties. So, with the expansion of SPP into the Western Interconnect there, and we'll talk a little bit more about this when we get to the slides, but there are 7 places in, all along the western border of the old SPP RTO boundary, in which electricity can transfer and flow back and forth between the Eastern Interconnection and the Western Interconnection. Those two, the country is essentially divided down the middle with regard to its electric grid. And those different areas of the country they operate in different frequencies, electricity frequencies. And so in order to transfer power back and forth, you have to go through these things called DC ties, and they are aging and they have very little capacity, and SPP is going to evaluate whether it makes sense from an economics and reliability perspective to expand the size of those. All right. So this was the first, I would say, substantive, or at least interesting enough to me to warrant a slide and some discussion in this presentation, decision or approval of the board, SPP board, during the last board meeting. And so, if you recall, this line was one of the 765 kV lines. That was, I forgot, you can't see my cursor over here. So this was one of the 765 kV lines that was approved in the 2025 ITP plan. And it was this Seminole to Shreveport 765 kV line. Now, you might recall that this area of the system actually experienced load shed in 2025 during a relatively mild summer time of the year. I mean, actually, it was late spring. There was also another 765 kV line that was approved in the extreme far southwest corner of the state, or of the footprint. And that was also to address, acute reliability issues that were occurring. Basically, just the transmission system just could not move the amount of power that was necessary to keep the lights on for these areas of the system. So what happened in this instance is, once these lines receive a notice to construct, it's not like it's over and the transmission owning entity goes out and starts to construct these lines. It's oftentimes several years before construction begins on these lines. And so there will be continued evaluation and analysis by SPP staff in terms of, do we select the correct line? Is the termination point exactly where it should be in terms of the maximum reliability and economic benefits associated with these projects? And so what happened here is SPP staff, actually AEP, American Electric Power, requested to reevaluate the termination point on this line. Instead of it terminating at a substation in Shreveport, just outside of Shreveport, and the substation is called the Southwest Shreveport Substation, AEP suggested that the better termination point may very well be Longwood. And ultimately, that recommendation to reevaluate and change the location was approved by SPP staff and then ultimately by the board. Here's the rationale and the analysis that occurred as that led to that. There ended up being additional amounts of load that was signing service agreements in and around the Longwood substation, and ultimately, and they also were forecasting cost increases associated with the original substation at Shreveport. I think the rationale there was it was a constrained, relatively constrained substation that wasn't going to be easy to expand, and so ultimately this was anticipated to reduce overall costs based on the reduction of the amount of 765 kV that needed to be built. And ultimately, this was approved. So instead of Southwest Seminole to Shreveport, this will now be referred to as Seminole to Longwood. There was another reevaluation that occurred from the 2025 ITP as well. There was, if you recall, another one of the lines that was approved was Seminole to Anthem. It was, and we'll see some of these lines later on some of the maps that we look at, but it was almost like a greater than and a less than sign on, not quite a full X, but like two different 2/3 of a triangle in the southwest and southeastern portion of the footprint is what was approved in the 2025 ITP. So this reevaluation and termination point change addresses both of the 765s on the right, southeastern portion of the footprint, or the right portion of the southern footprint of these 765 kV lines. So this was a situation where, again, AEP submitted a request to reevaluate the termination point. It was originally expected to go to Anthem, which is a little closer to, you can see on the map here, it's a little closer to the suburban areas or the urban corridor areas of Tulsa. And their recommendation was that this would be a better termination point in the Guava substation. There was additional load that has signed firm service agreements at Guava. It results in a little less 765 kV transmission being built, just a shorter distance. And it was really interesting in that this just goes to show you how, I guess, how unintuitive sometimes, to me anyway, the transmission modeling, economic modeling scores and results can be, because this changing the termination from one substation to the next 7 miles away is going to result in over $100 billion of adjusted production cost savings over this 40-year period of time on a net present value basis. So kind of amazing. This was definitely a no-brainer. And this will, oh, actually, I'm sorry, this was going to increase costs. This was going to increase a little bit of the cost of the substation, but it was going to reduce the amount of the transmission line miles. And so ultimately it was a cost savings in terms of the overall engineering and construction costs, but the adjusted production cost savings were pretty incredible. And I also said earlier, I said it wrong in terms of it wasn't the net present value. This is $114 to $119 billion per year of adjusted production costs. So it is sort of a good example of how, once these projects receive a notice to construct, especially for these big lines like a 765 kV, they're not expected to be in service for 7 to 10 years. And so there will be additional refinements and fine tuning that occurs in the interim period of time before ultimately line siting and construction type activities occur. And this is, it's an interesting case study that, the economics of where those lines terminate may get better, it may get worse, it may change over time. Okay, this is the new study that I mentioned, the We Expand study, Western Eastern expansion of exchange pathways and network development. It's just an interesting acronym for sure. They continue to get more and more creative with acronyms. So this is the graphic that that shows what we were talking about before. There are there's basically there's three separate major electric grids in the United States that are all basically connected. The Western Interconnection, the Eastern Interconnection, and ERCOT, the portions of Texas that are in ERCOT. Right now, the DC ties, the reason that it's called that is because the electricity that is flowing over these lines is in alternating current. But again, they're on different, I don't know if it's frequencies or different phases. I think it's phases, they're different. And so the timing is not the same. So in order to transfer electricity back and forth, you have to go from alternating current, convert it to direct current, and then convert it again to alternating current on the other side of the seam. Right now, that the ability to transfer power between the western portion of the United States and the eastern portion of the United States is 1,300 megawatts of electricity. That's very low. That's less than 1% of the peak of either one of these interconnections. And there's a lot of there's a lot of theoretical support for the idea of the ability to exchange larger amounts of power between these interconnections. You can go online, I mean, we could pull it up right now, and there's probably a pretty significant difference in the price of wholesale energy in the Western interconnection versus the Eastern interconnection. Some of that makes sense because of just geography. The sun, of course, is moving across the United States, west to east. And so if it's 5:30 or 6 o'clock, and the eastern portion of the Rocky Mountains is peaking, and it's only 3 or 4 o'clock here, we may have excess power that could be sold to the Western interconnection to benefit customers in the state of Kansas. And likewise, there are times where we are peaking, but they're just past their summer peak or their evening peak, and there's opportunities for them to sell us power at cheaper than we could otherwise generate it. So, but that's that's theoretical and not an analytical evaluation or an approach at this point. And so that's the purpose of the study, is to evaluate what benefits are there really, how are those benefits going to be shared between the Western and the Eastern portions of SPP, and then ultimately that will provide the analytical support to support a cost allocation for these investments that are necessary, if they're necessary, to expand the size of the ability to transfer power back and forth.
Can I ask a question here?
Absolutely.
I'm just sort of curious with this back and forth. Are they talking about what's going on with the hydropower, since water is becoming such an issue in the West?
It's definitely, it definitely has been part of the conversation. The West has been not only, there are portions of the West they're experiencing diminished capacity, hydropower capacity because of the drought that they're in at this time. But there are also there are resource challenges and limitations in the Western interconnect right now, right? And there were several really, really close calls this summer where the newly expanded members of the Southwest Power Pool in the Western interconnect got really, really close to load shed a couple of times, this summer. And so during those periods of time, it's imports that allowed the West to have the lights stay on. So some of those came from the East, but that's very, very limited because of these DC ties. A lot of those imports were within the Western interconnect and came from other neighboring regions.
Okay.
But it is interesting because so you see these are just sort of high level bullet points in terms of why the consensus is that it makes sense to study this. So they're saying, look, this isn't minor price divergence. This is pretty significant. The marginal energy costs are greater than $30 a megawatt hour 35% of the time. So when you think about, remember this, when you see something that says megawatt hour, right? Well, the average retail customer uses 1,000 kilowatt hours a month, which is 1 megawatt hour, right? So what this is saying is, look, this is the possibility, the potential to lower an average residential customer's bill by $30 a month, as an example, right? When you see $30 a megawatt hour, that is a major, major change in the cost of fuel and purchase power. You know, if that price divergence could be eliminated and that occurred all year long or all month long, for instance, there's, you know, the West tends to have a greater duration of higher prices. But the East, interestingly enough, the SPP, you know, the native original SPP portion of the footprint has higher extreme prices. And that may very well be, honestly, that may very well be because of the greater proportion of, it depends on the month and the day, but there's a lot more solar, for instance, in the West. And so those solar resources may be holding down the extreme high prices that we can experience when we are dipping into the most expensive generating assets that exist to serve portions of the East during those extreme, you know, peak days. But it is interesting. They're saying, look, 40% of the time, those ties are at maximum flow. So they are being optimized every day by the integrated marketplace today, now that they have been, that the West is a part of our RTO. And they're saying, look, it's actually relatively balanced in terms of how often power is moving west to east versus east to west, which is interesting. But that's what they're saying. They say the direction of flow is balanced between both BAAs today. But this is all, again, this is pretty high level. And, you know, if this slide was all we needed to know to upgrade these ties, then we wouldn't be doing the study. And they are doing the study. So this is just talking about, you know, some potential benefits. I mean, these benefits aren't much different than what you would see with expanding interregional transmission capability, you know, the ability to share operating reserves across the seams, or instead of maybe both sides of those DC ties, both entities building power plants. Maybe you can build one power plant and share it across those ties. Ultimately, this study will provide the analytical basis to allow a determination on cost allocation as well for these investments, if there are any. And this is just a high level. It's going to be a while. The study will take a year. Ultimately, they will present the final results around this time next year, maybe the first quarter of 2028. Okay, so this was an update provided by SPP operations staff about the summer of 2026. Normally, I include these kind of slides in the appendix, but I thought these next couple slides were really interesting, and I wanted to call them to the commission's attention. So SPP did set a new all-time summer peak this year. That peak, as you can see on the slide, was 58,127 megawatts. But that peak broke the two previous highest peaks that were also set the week prior to that. So in a 1 week period of time, SPP experienced 3 new all-time peak loads. You know, the interesting thing about that is the last peak that was set was August of 2023, and that 56,000 megawatt peak was a very unusual event in SPP weather history. That was a true heat dome that settled into the central part of the United States, and actually SPP set like 4 or 5 new all-time peaks in a 1 week period of time. So it was truly a challenging period of time operationally. back in the summer of 2023. This peak was set with weather that was not near as hot as 2023. It was not near as extreme of a scenario. And you'll see that on the next slide in terms of, and I think the next slide to me is really not instrumental, which is what I was going to say. It's really informative to me.
Instructive.
Yeah, absolutely. Thank you. Because you get to see that with the same temperature over the entire year, load is just a lot higher today than it was a couple years ago. And a few other interesting elements of this particular event, this particular peak, and also that differentiate it from the last time is, we used to be able to say, and as soon or as recently as the last predetermination docket, a few years ago, we said, look, there's almost no solar, utility scale solar in SPP. But that's no longer the case. There was 2.1 gigawatts of solar, 2,100 megawatts of solar that was online when SPP set its all-time peak during this event. And it, that was interesting. There's quite a few imports coming in as well, 1.3 gigawatts of imports, but actually in this instance, the solar in SPP was almost double the amount of imports that we were able to bring in. And that, I don't know, when you think about 2,100 megawatts of additional capacity that's been built in, that's a pretty short period of time, 2 or 3 years, right? That's 2 Wolf Creek nuclear power plants, right? In terms of the capacity that generation was providing at that time. This slide's a little bit messy and it's a little bit difficult to read. It's basically, you have to kind of, zoom in and look at that legend on the right side of the graph, but it shows from its load plotted against temperature for the entire year. And the 2 years that are called out specifically are 2020 and 2026. And it just goes to show you, it shows how across different temperature bands for the entire year, basically SPP is serving more energy and more peak demand all hours of the year, and substantially more than just 6 years ago. Okay, now we're getting into the fun stuff. So these are the slides. This is everything that I have seen. This is taken from a pretty wide swath of different meeting materials, different presentations that I have shamelessly stolen the slides from SPP. And so some of these come from the most recent board meeting and RSC meeting. Some of these come from the engineering summit the last week of July in Denver. But this is all pretty hot off the presses, and it represents the most updated information that I have. This is the first one is just, sort of an overview type slide. It's a reminder of the different deliverability areas that exist within SPP. Just as a quick reminder, what a deliverability area is basically the engineering. There was engineering study and analysis done 2 to 3 years ago at this point that made the determination that, look, really power in SPP is most interconnected. It flows the best across these general deliverability areas, right? And so everything north of the border of Kansas is in the north deliverability area. Kansas and Missouri are tied together in one deliverability area. And then everything south of the border of Kansas is in the south deliverability area. And also as a reminder, there was a cost allocation change that the KCC was very instrumental in and supportive of, that basically fixed what was sort of colloquially referred to as the sunflower problem, right? The situation where, and Midwest as well, where you have resource intensive, renewable energy resource intensive areas of the footprint and of Kansas, like in Western Kansas, that the addition of all of that renewable energy was at times driving additional transmission investment, and that transmission investment was being borne by the local transmission customers. The determination was that this really, we should be sharing those kind of transmission investments over a broader area known as a subregion. And Kansas and Missouri are in one subregion that we are sort of fortunate in that vein, because the subregion matches the deliverability area perfectly in Kansas and Missouri. The North and the South can't say that necessarily, because there are two different subregions in both the North and the South. And so there's a little bit of a mismatch there. We would have supported a perfect alignment of deliverability and subregional cost allocation areas, but that's just not the way it worked out in the North and the South. So that's just a quick reminder of, the different deliverability areas. And that's, as we get into some of the potential cost allocation changes that might be coming for transmission above 345 kV, I think that, that reminder is worth highlighting. Go
Yeah,
ahead.
and Justin, I was just gonna kind of put a little finer point on it, and you can tell me if your understanding's different. I mean, it's not that these three subregions are completely disconnected at all. There are a lot of flows around the entire region. Energy on a daily basis flows fairly freely among the whole region. What they are really capturing among these three subregions are sort of the expectation that if you plop a power plant down in one of them, how firm is delivery going to be to somewhere else in the region, and and that matters to things like accreditation, and making sure that people have capacity value available to them. And these are the regions where I guess SPP, through their engineering analysis, feels very confident that if you put a supply in one anywhere in either say the central, so say Evergy puts acquires capacity in Western Kansas, the connectivity is such that there is a very high confidence that they can count that capacity toward their requirements, and that it will be available even on sort of the most challenging of days. I think they use like a light load scenario day, something very specific. Even on the most challenging days, it'll be available. But that's not to say that power does not, on a day-to-day or hour-to-hour basis, sort of flow around the whole region. So just putting a little finer point on that.
Yeah, no, I appreciate that. That's absolutely right. I mean, it was the effort to identify the deliverability areas was based on a host of different factors, right? But one of them was interconnectivity, like prevalence of transmission interconnectivity amongst the different states and the different areas of the RTO. And then I guess pretty importantly as well, once the Capacity Resource Interconnection Service, or NRIS Plus, once that tariff mechanism became effective, to your point, you can build a network resource anywhere within your deliverability area, and SPP will protect firm transmission service from that resource to your customers. So that's another really, key important point, right? And so, there's different positions, I think, regarding how strong the connectivity is amongst the different deliverability areas, but those are the deliverability areas, and they have been approved by FERC.
I'm also going to say that SPP used ChatGPT to make this slide because I'm not sure about some of these state borders. Nebraska doesn't look quite right. I think we took part of Nebraska. Sorry, that's an aside.
Yeah. Yeah, no comment on whether or not AI was used to make all of these slides. All right. So this is just another slide that I took out of the engineering summit materials. This, high level in terms of the 2026 ITP, what's driving it, what ultimately, we'll see, and we're going to be talking about a lot more over the next several months. And you'll see some of the specific details of these points called out in these upcoming slides. So SPPs, these numbers are, I don't know, the load growth numbers are interesting for sure. I mean, I don't know that I want to say shocking. I mean, they're because we've been hearing them for a while, but they are becoming more and more real. They're definitely advancing to the point where these load growth numbers are something that is no longer a possibility or a potential that's going to occur. This is load growth that is already under existing signed agreements, firm network service agreements that these customers are being energized as we speak. And so today, SPP, we just saw that the current peak of SPP is about 58,000 megawatts or 58 gigawatts. There are signed network service agreements to add 9.6 gigawatts of additional load to the system. And that is not all, data centers or computational load, but that's also reshoring of American manufacturing and new manufacturing plants. There's oil and gas electrification load that's included in that analysis, but where there is a certainty of a 17% growth in peak load over the next couple of years. And they're saying, and this number is a little bit outdated because this is 2 weeks old, there is 10 gigawatts of additional load going through studies, AQ and AX studies right now. Those are studies that say an AQ study is you already have enough network generation service to serve this load. You just need to evaluate and make sure the transmission system can carry the load. AX, attachment AX, is you are actively attempting to acquire the generation that's necessary to serve these customers, and you will have it within the time frame that the load is going to come online, but you need to evaluate and determine that the transmission system is capable of carrying the additional load. So, and we're going to talk more about some of these load forecasts and projections here in the next couple of slides, but what we're talking about is a nearly certain 35% increase in peak load in just the next couple of years. So, it's really unprecedented, remarkable levels of load growth that we have not experienced in the utility industry in ever.
Yeah, Justin, I'll give my 2 cents here on, what I think about this, which is it's bad and good. I mean, it shows that we really do have a challenge because it's going to be challenging to meet some of this, particularly in the near term, as we know how long it takes to get infrastructure built. But I will say the piece that gives me comfort, I guess, is, probably a year ago, it was more scary when we were hearing these numbers, but we had no assurance that they were really real. And so, that gives you a lot of pause on, whether you want to invest or what you should actually do. I will say the upside of a lot of this moving toward, you know, service agreements and really getting firmed up is at least it gives you more of a sight line into where you need to be in the future. And I mean, I think some of the uncertainty at least is going away. And for me, that is the most challenging part is the uncertainty. And don't get me wrong, there's still uncertainty, but I think it does help to know what the trajectory looks like with more certainty at this point. So that's just, I mean, I think we probably are thinking about that the same way. I just want to make sure I put that out there.
Yeah, no, that's right. I mean, it's, you know, and when we go through some of these load projection curves later, I think it'll become even more clear is that for the last several years, when we first started seeing some of these projected increases in load in a future two scenario, for instance, you know, it's easy to discount a future two load planning scenario as well. Yeah, but that's supposed to be the speculative stuff that we're not really sure that that's coming. That's sort of it's an extreme planning scenario on purpose so that you don't get caught, you know, not able to serve, not able to maintain reliability or economics of power flow. But what is becoming more and more clear is that what was a extreme planning scenario 2 years ago is actually below service that customers have already signed up and are beginning to be energized. It's, you know, the future two scenario 2 years ago is now below the base reliability planning scenario, which if you don't plan to serve load that is in the base reliability planning scenario, that's a NERC violation. You have to, you know, SPP doesn't have an option to not serve the load that exists in firm service agreements. So anyway, we'll get into a little bit more of that here pretty soon. So, all right, these I can't interpret these models. I'm not a electric, you know, transmission planning engineer. But these are the models. These are the screenshots of the model, the reliability models and the economic models that SPP uses to show, I think, the depth of the granularity and the analysis that goes into the modeling that produces the recommendations for these transmission lines. So these different model sets mean, you know, there's a definition for each one of these model varieties: the base reliability, base generator expansion, transfer generator expansion, and the market economic model. You know, we could get SPP planning engineers to give us a 1-hour explanation for what each one of these models refer to, but what they are showing is widespread, extensive reliability issues throughout the entire footprint, associated with the desire to bring online the additional generation, the additional load that is coming, and the additional generation that's necessary to serve that load. Then you see the market economic model is producing signals, and it's producing recommendations for projects, but the model, the first three models, those are thermal and voltage issues, right? So I think it goes to show you it is reliability. There's one previous point from the previous slide that sort of, you know, jumped out at me, which is that this bullet point here, 21,500 unique needs. And what they're saying is that level of need has tripled each year in the last 3 years, right? So despite the fact that there was there was, you know, $8 billion of transmission for the region identified in the 2024 ITP. There was another $8 billion in 2025. But these none of that 765 kV has been built yet, right? We know that. There were lines that were identified in the 2024 ITP that we know that are either in siting proceedings right now, for instance, in Kansas, or they're getting ready to come. So I'm saying things we all know, but it takes a long time to build transmission. And, it's obvious that the system conditions are getting out in front of the ability to actually address those reliability challenges by building transmission. So.
And Justin, the only thing I wanted to add, you touched on it, is beyond, really it's all a little bit hypothetical, and I think Justin and I want to test some of this, but if you believe the models, I think what they're telling you is, yeah, as Justin really highlighted, it's we will have, if you don't build projects, we will have unacceptable levels of reliability degradation below what NERC requires. So there'll be NERC violations, which is not that can't happen. But we also don't want customers to not be served. So there's a reason for that. But the other piece is the economic piece, and I think this is a little harder for some people to get their hands around, which is if this level of additional customers show up, and we don't upgrade the grid, you will have so much congestion on the grid that that wholesale prices of energy are going to go up very materially. And we've enjoyed the lowest wholesale prices in the country for a long time. I think folks want that to continue. But what this is telling you is not only would you have more chances of outages, very likely outages, but you also would see a big hit to affordability if you don't make some of these upgrades. I don't know that all of them will be needed, but I mean I think that is a difficult concept for some people. That it's definitely been a difficult concept for me over the years of that you have to make these investments to keep energy affordable. You got to spend money to keep costs down, and that is very difficult, but I think that's what the models are showing us, is if we don't stay ahead of it, we could potentially be putting upward pressure on costs. So that's the only other thing I wanted to emphasize, Justin.
Yeah. Yeah, and much more to come, right? They haven't finalized the portfolio yet. That once it is finalized, then the benefit cost metrics will start to be evaluated. There's still a lot of additional information to come. So, all right. So I don't know, this is an interesting slide to me. But it is also, and it'll tie into the next one that we're about to look at. Now, these are, the left-hand side is the future to year 20 spot loads. And also just general load concentration that is in the year 20 modeling. Now, SPP is, they're required by FERC Order 1000. That's not that. What FERC order is the most recent?
1920.
Yeah, that's right. They're required by FERC Order 1920 to evaluate the 20-year load forecast and plan the system on a 20-year basis, but they are not issuing notices to construct that come out of that 20-year study. But I think one of the reasons that this is presented is to show that it's just to show in general what the expected direction of load increase is expected to be. For whatever reason, it appears it's generally gradiating from south to north throughout the region. And then the interesting thing also about this right-hand slide, the Future 1 year 10 spot loads, you'll recall Future 1 is supposed to be business as usual. It's not quite as restrictive as a base reliability model. Base reliability says these are customers you have to, NERC requires you to plan the system to serve these customers. You have to. Future One says, okay, well, maybe not customers that you've already signed under agreements, but tell us, give us your load forecast that you're real certain you're going to sign these agreements, and you're so close. You're within 6 months of signing these agreements. That's what Future One's supposed to be. What we'll see on this next slide is and this is, I don't know, it's thought provoking for sure. The Future Two scenario that is being studied in the 2026 ITP is equivalent to next year's Future One. And that's been the case for quite some time now. For a couple years, as we discussed, people really, dig deep and try to be expansive in their load forecasts and try to get out ahead of what they think the load might be, and then 1 year later it's not enough, right?
Yeah, and Justin, I think, maybe you were going to call this out, but I think the obvious thing here is for Kansas, the next year's study is showing that the stuff in the Kansas City area that was sort of seen as quite speculative last year on a 20-year basis is now seen as pretty darn firm, close to certain, even on a 10-year basis. And then the really interesting thing I picked up on, and I need to talk to my friends at Sunflower, is if you look at Western Kansas, just a year ago when they said, give us your 20-year projection, somewhat speculatively, of what your load growth is going to look like, there's still almost no load growth. So they're saying, be wild and tell us everything that might show up, and nothing's there. And then all of a sudden, in next year's study, they have very substantial load growth on a very certain basis, only on a 10-year horizon. And I think that is definitely notable and definitely something we're going to want to follow up with our load serving entities out to the west. So I just want to make sure. I was fairly certain you were going to call that out, but it caught my eye.
Yeah, I appreciate it. All right, this is one of my favorite charts to try to explain. Been doing this for a couple years now. I'm kind of getting better at it, but okay, so, and I'm going to have to turn over here and look at this other screen. I apologize, so that I can use my cursor. Now, if you recall, we've been going through charts like this since about the 2023 ITP, but it just keeps getting more sort of eye-popping. All right, so let's start down here and think about in the 2024 ITP, just 2 years ago, when the first 765 kV lines came out, that were the Potter to Phantom to Crossroads, 765 kV down in the extreme southwest corner of the state of the footprint. The anticipated load growth for the system was to grow in over a 10-year period of time from 58 gigawatts of demand to 64 gigawatts, right? 1 year later, 1 year later, the expectation was that we would be peaking at 61 gigawatts. So almost 10 years worth of load growth in 1 year. And the thing that's kind of amazing about this too is you think about the 2025, if you notice on the blue line, the 2025 base reliability and Future One. So what ended up happening is, as the transmission planning, as we got further into that 2025 year, the service agreements that they were planning in Future One became so certain that they just it became the base reliability model. Okay, so that at that point it's a relatively flat trajectory of what they were expecting for base reliability in Future One. And as a reminder, those are the models that created the 765 kV lines that came out of the portfolio last year. Base reliability models. Okay, well then the future two from 2025 was, again, future two, you can see it's everything you have a lot of confidence in, and let's be creative. Think about what might come, but you don't have a lot of confidence in. So the future two load forecast would have been 75 gigawatts of additional 75 gigawatts of peak load around 2031 and about 80 gigawatts by 2034. At this point, the future one, the most certain scenario that they are now planning for is 84 gigawatts of load by 2030. So it's difficult to overstate that. I mean, just last year, the most expansive the least confidential or the least confidence load forecast of all the utilities in the region was that in 10 years, we might get to 80 gigawatts of load. And now that is a near certainty by 2030. Okay, so that's 35 gigawatts of additional load growth in 4 years. And this is really interesting too, but so it won't be long. In 5 months, we'll be looking at the 2027 ITP, start thinking about that, evaluating that. The 2027, this red line is future one. And next year, when we're looking at this, the most certain load forecast will be 101 gigawatts of additional load by 2030. So a near doubling of the size of the system in under 5 years. So anyway, I mean, those are difficult concepts to really grasp and to buy into. But what we've seen is that so far over the last 2 or 3 years, the most extreme load planning scenarios have actually ended up being too conservative, right? For about 3 years in a row now. Okay. So this is just another sort of high-level overview slide for the 2026 ITP that says, so what's the portfolio going to look like? And this is, I think, a reminder from SPP that we are going to present. I'm speaking in third person terms as if I'm SPP now, right? Like they're saying, look, we're going to present a portfolio to the region that we think is necessary to meet reliability standards and keep the wholesale power markets economic. But we are not going to issue notices to construct for every one of those transmission lines. And we have seen that, last year, the portfolio itself was around a $19 billion portfolio. And ultimately, there were notices to construct for around $8.6 billion. A few of those continue to be revised still today. None of those lines are under construction yet. And this is just another graphic representation of, the different factors that go into whether or not they actually will recommend a notice to construct. Another sort of something to remember is that when this portfolio comes out later this year and the board approves the issuance of notices to construct, what that really means is that they don't issue a notice to construct. They approve the issuance of a notice to construct. That takes a long time. It takes several months. First, they issue a notice to construct with conditions. They have to refine the cost the cost recommendations or the cost estimation of the projects. Ultimately, it will go into an actual notice to construct. And then engineering and planning starts on the lines, and there still is there's no construction or line siting occurring today based on any of the 765 kV that was approved originally in the 2024 ITP. So it's important to remember these are 10-year plans, but it's also, I think, important to recognize that the load growth it's caught everybody sort of so off guard, or it's caught everybody by surprise, so that you can't get ahead of it at this point. But these are long-term plans. All right, we're getting ready to start getting into.
If
Go
I
ahead.
may interrupt briefly.
Oh, absolutely.
This is Dwight. Yeah, I'm trying to wrap my thoughts around the really serious, with this load growth, the really serious balancing proposition that we're going to face near, intermediate, and long term, basically in terms of trying to balance reliability with affordability, and how difficult and problematic it strikes me that that's going to be. I mean, it's one thing to kind of talk, and this is not a criticism. This is an action of it. I don't blame you for the intimidation factor that it presents in terms of trying to grasp the consequences of it. But you're being Joe Friday here. You're telling us the story. This is the facts. This is where we are. So I'm having a real difficult time trying to anticipate, with this level of load growth, how we maintain affordability for ratepayers, all classes of ratepayers, residential, commercial, all classes. Any thoughts on how you can kind of talk me down on the apoplexy I have about that?
Yeah. So, I mean, trust me, we're all on the same page in terms of that concern, right? I mean, one thing that I think will really help, and once we start to get into what the potential rate impacts of these lines are, I think you'll see it is. And I mean, this is intuitive, but not everybody thinks about this all the time. But you can double the amount of investment in the system, and if you double your load growth as well, then rates don't go up for existing customers, right? I mean, at the most simplistic rate making calculation there is, it's just total revenue requirement divided by total sales. And you can double your revenue requirement, and if you double your sales, you don't have to increase costs to other customers, right? So that is a big part of it. And of course, we're only looking at the transmission system here. So when you start to think about the fact that these big customers are also paying for everything that was built before them, right? So when you start to think about, if these customers locate in your service territory and they start to pay for, I mean, the elephant in the room, right, is the data center discussion, right? I mean, it's data centers. It's not only data centers. We continue to try to understand and peel back exactly what this load growth is. But I just heard a new number. I was in Chicago on Monday at the CARE team, and I know Chair French was online listening. We heard something that was really fascinating, right? So I had to write it down. It was so fascinating to me. There's 34 gigawatts of load that is being studied right now in terms of its ability to interconnect to the system. And only 13.7 gigawatts of that is data centers in SPP. And I mean, I stopped the meeting and had to, we had conversation about it. I mean, that was a shocking number to me. But
roughly a third, basically, right?
Yeah, it was. But on the other hand, there's already been 10 gigawatts of high impact large loads that have been signed. Now, that does not mean data centers, but that means anything larger than 50 megawatts at one point of interconnection. But so if you add that 10 gigawatts on, then you're looking at like half of this load growth is big customers all in one place, and the other half is just organic load growth that's occurring more equally distributed throughout the region. Some of that is oil and gas electrification in the Bakken and in the Permian. But anyway, what's interesting about, I think this is a reality that we're all going to sort of wrestle with here is if these customers are coming and they're coming somewhere and they're going to be served in SPP, and SPP has a NERC obligation to build the transmission system to serve them, then the cost increases are coming. And the question is, will you have an increase in billing determinants in your area or not? You know, if you don't have an increase in billing determinants to be able to spread your existing fixed cost out, you know, not only just for the transmission system, but for everything else that you built over the last 100 years to maintain this giant machine that we have, then I think that is that's a real issue. That's a real concern of, do you want your state, do you want your region to be left out, so to speak, of the ability to spread these additional fixed cost, the existing costs as well as the new costs out over more billing determinants?
Right. Okay, very good. That's helpful in providing kind of a holistic overview. I appreciate that.
Yeah, Justin, I would also just say, maybe I'm just regurgitating back what you just said, but the way I've been thinking about it is, yes, I mean, a lot of the investment is for load growth. So that does mean, you know, you're going to mitigate the affordability issue because you've got a lot more people paying. Now, I do think there's one little caveat to that, which Justin knows all about, which is that new infrastructure is probably going to cost on average more than the existing infrastructure. And so, you know, we probably want to make sure that the new customers driving it are paying maybe more for some of that incremental cost. That is in heavy discussion right now. So I'll leave that there. But then the other piece of that is like, I'm not taking a position on data centers or large load or anything, but at least as far as the cost allocation piece goes, I think what Justin was saying is something I've said as well, which is honestly the greatest protection to make sure that your state isn't having increase rates, or that your existing customers aren't impacted, is to make sure that you have a portion of that new load locating in your area to soak up any extra cost. So, I mean, and I think that I just said what Justin said a different way, but that's why that is one way that I'm thinking about it. And that's why, I mean, I think you'll hear some of the areas to the north of us are actually more concerned. They're probably where we were a year ago, because that load is not materializing in their area yet. And so they are looking at potentially paying for portions of a build out when they may not have extensive load growth to help pay for that. And where we are seeing the load firm up much more in our area, we have a very high expectation that there will be a lot of billing determinants to spread new costs over. But that issue definitely exists for the north. So, and I don't know, Justin, if you were going to get into that with care team materials or anything, but that is part of the discussion right now.
Yeah. Yeah, no, we'll get into it. Commissioner Keene, are you good for now? You want to move on?
Yeah, no, let's move on. I appreciate it very much. Your overview was helpful.
So we're getting ready to get into some maps here. And this is one that I found was also instructive, useful to me, in that, you know, you guys have seen these kind of representations before, which is that, you know, the transmission planning engineers of SPP, even though there's 30,000 new needs that are driven by, you know, this load growth, they still focus on certain areas of the system. each year, right? They will take an area, and sometimes it's because it comes out of there's persistent operational issues in that area, or maybe the market monitor identifies extreme congestion affecting customers and prices in this area, and so they'll focus on that area. Well, the red, you can see the red circled areas were areas of interest in the 2026 ITP, and the 2027 ITP is in the Southwest Kansas, Northwest Oklahoma area. And that is mostly, I think, because of what we showed a few slides ago, which is that it appears that there are additional high confidence, high likelihood load that is coming in that Southwest Kansas area for the 2027 ITP. Okay, this is the first map where we are showing at this point, the most likely potential 765 kV lines that are, I would say at this point, very likely to get notice to construct in the 2026 ITP. Now, this slide came out of one of about 50 different potential configurations of the 765 kV lines. This is a slide that was presented at the engineering summit in the last week of July in Denver. And I brought it in and sharing it with you all now. So this is not final. There are still, there's still a lot of conversation going on. They are contemplating, I think, still the possibility that this loop may need to be extended up into the Omaha area. But if you had to handicap it, this would probably be the best bet at this point in terms of what SPP is likely to issue for notices to construct for 765 kV. You can see on this map as well, you can see the lines that were approved in the 2024 and the 2025 ITPs. This is that Potter to Crawfish Draw, Potter to Phantom to Crawfish Draw, original 765 kV from the 2024 ITP. They, in the 25 ITP, almost closed in the loop on the east side of that 765. So this is the first sort of 2/3 of a triangle that was approved in the 25 ITP. And then this Guava, and it's now Guava, it used to be Anthem, right? Seminole to Guava and Seminole to, I can't remember, Longford, I think, this is the other side of the sort of 2/3 of a triangle that was approved in the 2025 ITP. They're saying it's likely that they will close that in with Lawton to Crawfish Draw, and then as well Potter to Woodward, Woodward to Viola, and then again, it looks like the most likely scenario is that they will recommend a new greenfield 765 kV substation and a loop around the Kansas City metro area for this upcoming 2026 ITP. There is, and just actually there's a slide that we will go over that shows a potential configuration for 2027. And I think there's still in heavy discussions about whether or not this actually is necessary for this planning session. But there will likely eventually be another 765 kV line either coming out of Woodward or coming out of Potter and going up through western Kansas around that Holcomb area. And then, whether or not that loops back into Saylor is, I think, still yet to be seen. But this is This is the first, this is the most recent and probably the most representative map of potentially what we might see coming out of the 2026 ITP. Okay, this is a graphic that was distributed at the engineering summit. And, you know, I really do, I think this really deserves a lot of focus. I think, you know, I think especially because this voltage class of transmission is new in SPP, it's new in Kansas. There's a lot of apprehension. There's a lot of you know, trepidation about, you know, about this new technology. It is more expensive on a sort of a headline basis. You know, as an example, you can see on the bottom line of this graph, you know, to build a 765 kV line per mile is about $6.4 million a mile, which is obviously more expensive than a 345 kV line, about double the cost of building 345 kV, which is around $3 million a mile today. But, you know, what the graphic and the underlying data within the graphic show is that, yeah, it's twice as expensive, but you can move 6 times as much power under certain conditions, and you can move, you know, 4 times as much power under the least restrained conditions, I guess, or constrained conditions. And so, you know, I do think that this is a really important part of the story, and everybody knows that it is not easy to site this kind of infrastructure in today's environment, and probably never has been. You know, this is infrastructure that has a direct impact on people's lives, and does affect ultimately the usage of land in our state. And you know, the graphical representation on the top portion of this slide, I think, presents what people eventually will come to find out is sort of the reality of the situation, right? So if SPP is telling us that you cannot add the amount of load and the amount of generation that we need to in the central part of the United States and the rest of the country without additional transmission, then there will be decisions that are made in terms of if it is not a 765 kV line with a 200-foot easement, then we can build 3 500 kV lines, each one of which has a 175-foot easement right next to each other. Or we can build 6 345 kV lines, each one of which has a 150-foot easement right next to each other. And I just think, you know, that's the stark reality of planning the electric transmission system in today's day and age. And you know, I think this is a major part of the conversation to be had, but it's a major part of the educational effort that's going to be necessary to get people comfortable with why are we actually doing this? And I think ultimately what the math, sort of the pure engineering, you know, the facts will show is that it's actually the cheapest and least intrusive way of building this infrastructure that is critical infrastructure for our economy.
Yeah, Justin, you know, I was going to kind of say the same thing, which is it's interesting. I mean, people hear 765, they see the cost associated with it, and of course it's big and it's costly, but you know, I think actually if you ask the engineers at SPP what they would really like to have, Mike, I'm speculating a bit, but I think they'd like to have 6 345 lines because what those engineers really don't like is contingencies. They don't want one big contingency, you know, a large power plant or one big transmission line that's really key. You know, they would rather have 6, where if one goes out, it's not it's not a big deal. I think, I mean, honestly, I think the fact that they're looking at the 765 is a recognition of what you just said, which is they understand that cost is a really big deal, and they understand maybe even a bigger deal is the land use issues in today's day and age. And you know, it's counterintuitive, but I think that's actually those are a lot of the driving factors that are pushing them to the 765 instead of the lower voltage lines. So yeah, just kind of saying what you said a different way. But I think from a reliability standpoint, they'd probably prefer to have lines everywhere. But we know that's not realistic at all to us or the people of the state.
Justin, if I could interrupt here, Chair French, not to talk over you. If you'd finished your thoughts, I'm hoping. Okay, great. Yeah, my concern is that the philosophy may very well be let's put these lines everywhere and anywhere. But that's really an aside, I hope, in jest. Let's go back to the prior slide if we could, Justin, in light of your comments on this slide.
Absolutely.
Yeah, thank you. Okay. In Oklahoma, in Northeast Oklahoma, Guava, is that a location in Oklahoma?
It is. That's a substation in Oklahoma, Guava. Yeah.
Okay. As it heads up toward the Sailor area, it strikes me that a part of that line is, and then the line from Viola to Guava, the combination of that in 765 terms replicates what's happening with the lines that are under consideration now, 345. I guess I'm concerned about, is there some potential duplication of effort here? But even more than that, what are the generators? What are the sources of generation for these anticipated 2026 ITP 765 lines? Whereabouts are they?
Yeah, no, those are excellent questions. And hopefully SPP, and I know that they watch these presentations, so hopefully they're taking notes, because I think those are excellent questions that they'll do a much better job than me answering on September 8th. But there's a couple of things that this doesn't demonstrate, that this doesn't show, and that this is only the 765 kV overlay that we're showing on this map, and they have been very careful to point out that there will be additional underbuild of the 345 kV lines underneath the 765 in order to maximize or optimize the use of that 765 kV facility. So, in other words, more specific to your exact question, all of the models that demonstrate the need for these lines assume that every previous line that has been approved in every previous ITP are all in place, right? So I think it's an excellent question, and their transmission planning engineers will be able to answer that question of, well, since you're going to build 765, I think it's a fair question. Since you're going to build 765 in these areas, do we even need Buffalo Flats to Delaware anymore? More specifically, it's for the other line that was just filed, the Sydney to Holcomb. That's a 345 kV line that, you know, it's maybe likely that in next year's ITP, SPP is going to recommend a 765 kV solution to go from, say, Potter up to Sydney, Nebraska. And so, you know, then the next question becomes, do you really need this 345 kV line? And I can't answer that in the
Sure.
detail that it deserves, the answer deserves to be, but they can, and I'll just forecast for you what the answer will be, which is absolutely right. What they will say is we probably couldn't build the 765 kV if we didn't have that 345 there, right? To step down that energy to move it, and I think that is a big part of it.
Well, my question in response to that will be why, but we'll save that for that moment. And I appreciate that. It's not fair for me to saddle you with all the nuances of what should be SPP's responsibility to account for. But it just strikes me that if there is this, I don't know quite how to express this, not being a mathematician, but if we have almost an arithmetic difference in the amount of power that can be transmitted through 765 versus 345, why are we having all these 345 lines? And can we step down from that and reduce the humongous impact, the potential impact that all of this suggests to land use? It's it this is it's that is mind-boggling to me. I'm going to be just that's a candid understatement, quite frankly. This we're talking about, and then if you add to that the possibility of even having more 765 in the western parts of the state to boot, I mean, holy cow. Um, there just needs to be a real, I think, accountability basically for need. That will really be pressed. Thank you very much. I appreciate your view. I'm not trying to use this as a mechanism to try to delay your going through what's a very formidable agenda this morning, but I appreciate very much your allowing me to
Oh yeah.
state the issue as I did, and your I think companion concerned with it too. Thank you.
Yeah, absolutely. And one more quick thing in terms of the question of the generator question, and it's a good one. They do address that in these presentations. I'm sure they will address it when they come in September. What they are feeding into their models are the IRPs that are coming out of each of the investor-owned utilities in the region. And that is reflecting the reality that there is more and more thermal every day, more and more thermal generators that are being reflected in those IRPs. There has been a pause in the degree of especially wind development that is in these IRPs, and at the end of the day, the generators are getting closer to the load. They're getting more and more focused at closer to the load. It's not directly on top of the load, but they will be able to answer that question. But the reality is, and this is a big part of it, this is not a generation versus transmission question. It really isn't. You can't solve these issues with generation alone, because you can't hook them up, right? You have to hook them up to something. And that is what the models are showing. You can't, if you wanted to island a large customer completely off the grid, that's possible, and they can do that. And there are some of those projects occurring today. But if you want grid power, if you want that generator to be able to be utilized to move it around the system, it's just not possible to build the kind of generation that utilities are trying to build to serve this kind of load without additional transmission as well. I mean, that's what they're saying the models are showing. And but those are excellent questions.
Let me have one follow-up to this again. I'm not trying to monopolize this. It's just one question kind of leads to another. As I see the anticipated layout here of proposed prospective 765 lines, it appears to me that, am I even close to correct, that the likely generation source is going to be thermal from the Permian? Looks like that they're down in the Permian area there.
Yeah, so I would, well, there are like, you'll recall the ERIS process, right? Expedited Resource Adequacy Study process. That was a situation where a few years ago, SPP, to a certain extent, was able to see that there is a lot of additional load growth coming. It takes 5 years to get through an interconnection study. We've got to do this faster. We've got to let these load serving entities get to the front of the line. And there was 14 gigawatts of additional generation, 90% of it thermal generation, that was identified throughout the SPP region. Not and so I mean Evergy, for instance, has, I mean, we've approved two 700 megawatt power plants that would be very, very close to these 765 kV lines. Evergy has a integrated resource plan before us right now that calls for another 900 megawatts of natural gas in Southeast Kansas. I know they have there's a possibility of a different combined cycle gen facility that's just over the state line in Missouri, in Northwest Missouri. So, I mean, I think the answer is there is thermal generation being planned and developed all over the footprint, right? Not just in the Permian.
Yeah, I get that. The genesis of the question is simply because it looks like a point of origin for these lines is in the area of the Permian, and that is one of the most prolific oil and gas potential areas, basins within the continental lower 48. So that was the reason for the question.
Yeah.
If we could go back, and I'll try to make this my last question, maybe for the day. If we can go back one more slide, can you go back to the previous slide before this one?
I hope it's not your last question of the day. This is
Well,
what we do this for.
okay. Well, now, as I see here, the area of interest for the 2027 ITP, as we go out into western Kansas, and then I see the possible interconnect to lines that pre-existing lines that go down into that Texas, New Mexico area, is one reason for this being an area is to provide perhaps points of outlet for generation sources in western Kansas that would feed into the electrification of the Permian.
I think that's a really good question. I'm not as familiar with Sunflower's generation plans and their expansion plans. I know they have a need for capacity, and I know they have quite a few aging infrastructure assets that they're looking to replace. But I think what's really important to think about here is that, and the reason why you see these lines, like, for instance, okay, this is a perfect example. The 2024 ITP is this purple line. This was a situation where they needed to move power into the Permian, right? Not out of it. It's because this area was sort of islanded, right? And of course, we know that these are AC lines. Power goes back and forth at the speed of light as it needs to, wherever it needs to flow. But in this instance, this was I forget, you can't see my cursor over there. In this instance, it was a situation where this area generally needed its electrification of oil and gas wells in the area, right? But that's what's driving the need for the transmission. So it was a load pocket, and there was a need for additional electricity to be delivered into the area. But ultimately, in the 2025 ITP, they said, look, we've got to be able to, what they want to do is loop it, right? For reliability and also economic purposes, these systems work best when they're looped. And so I think it wasn't a situation where we need more power to go into the Permian. It was based on the underbuild of the 345 that was in the area. It was, look, we have to have another 765 kV. And then in this 2026, they are very, very likely to loop that off. So if you look at what they're doing, because you can't afford to build one giant overlay for $65 billion across the entire region where everything is looped. It occurs in steps and it becomes looped together, right? And so, you can see these are just little loops. And that's ultimately what they're trying to accomplish with the 2026 as well. We got to get away from the thought process that these are bidirectional lines, that the general desire here is to move power from one place to the next. Sometimes that happens for a short period of time, like as an acute planning need, but otherwise the idea is to create a network, right? So that you can move power wherever it needs to move at all times. I think it's also real quickly, it's important to point out all of these white lines, this is the existing transmission system that exists today, right? It does not show it does not show all of the transmission that has been planned, but these are transmission systems that exist today.
Hey, Justin, can I offer one more observation on Commissioner Keene's question about why the area of interest, yeah, in Western Kansas for the 27 ITP? One, I think you're going to get a much better answer from the engineers at SPP than you're going to get from us. I mean, they'll be able to tell you exactly why that's the area of interest. I would offer, though, that if you call back to that slide where we're starting to see the load growth that's being studied in the 27 ITP. Yeah, so that right-hand slide, that was the one that I pointed out was very, it really popped to me that all of a sudden you've got this huge interest in loads locating in Southwest Kansas. If I was to just wildly speculate today, I'm guessing that that's their area of interest because they're trying to figure out how to serve that load growth in southwestern Kansas. But I mean, I think they need to answer that question. That's just me reading some tea leaves. The other thing I will say, Justin, if you can go back to the map, really either one of the maps, for anybody listening, if you see those those two 765 lines that they have preliminarily put in, far southeastern Kansas, the Guava to Southern Paradise line, and then the one in south central Kansas that goes to Kansas City, the Viola to Sailor line. I mean, first of all, I'll just caution that, the way these engineers at SPP draw lines is they just pick a point A to point B. They have a substation that they want to start at and a substation they want to end at, and they draw a straight line. But even given that, I mean, I will say, I think Justin, I won't speak for Justin, are a little alarmed at where those are going in the state. You've got one that's obviously going straight through the Flint Hills, and you've got one that's going through southeastern Kansas, which is historically a bit of a difficult place to sight lines, but also, it's got one point in Oklahoma and one point in Missouri, and appears to just pass through Kansas. Now, I'm sure there's going to be step down points in Kansas, given that it's an AC line, but that's a challenge as well. And I just want Commissioner Keene, you to know that Justin and I are already giving feedback to SPP about what might be realistic for siting, and definitely drawing on things we're hearing from Kansas stakeholders, things that the commission has said in orders. But I think when we have an opportunity to hear directly from SPP, it'll be a good chance for the full commission to give some feedback on what they think of the locations of those lines. Now, I mean, it's a balancing act. Obviously, anything you do that's not a straight line from point A to point B probably adds cost, but I think we're in a world where we need to think about balancing those things. When one final thought, I know this is a long thought, but it connects to my previous thought on the emphasis on looking at Southwest Kansas. It probably gives me some indication that these lines that we see right now in the 2026 ITP should be viewed pretty preliminarily. I mean, they might get an NTC, but they're not going to start construction anytime real soon. They are going to be subject to restudy in future ITPs, and I would not at all be surprised if, as Justin mentioned, they might run a 765 line through western Kansas, and that might, I'm out over my skis, but I think it is a real possibility that something like that Viola to Sailor line might go away. You might end up seeing something on the western side of the state, and then they might loop it along the northern part of the state, and potentially we avoid the Flint Hills. So that's way down the line. But I think these are all things that we are thinking about as we're having those conversations with SPP to make sure that they're building the right stuff, but they're also doing it in a way that we might think is palatable. So I know that was a lot of brain dump, but just want you guys to know everything that's rattling around in my head.
Yeah, I jumped
Well, I
ahead.
appreciate that.
I won't take long. I jumped ahead way too far. But this is another really interesting map to me. That's why I put it in here. Again, these are the likely lines that are likely to get an NTC in this year. But these are the ones that these orange ones are still a candidate. This is still a candidate for the 2026, and I think they're saying that's pretty likely going to occur in 2027 based on this being the area of interest. And so, but these change, right? There is another configuration that goes straight up. Instead of going through the Flint Hills, it goes straight up and then would interconnect and loop back into here. And then we really haven't talked a lot about it, but there's still a lot of uncertainty. Originally, if we'd had this conversation a year ago, right, what we were looking at is the likelihood that they were going to recommend an entire overlay throughout the entire region, which is, this is the first time, by the way, you're seeing the numbers that I've been talking about for about 6 months, which is, 50 to $65 billion is what it would cost to do the whole thing. But they're not going to issue notices to construct for any of this northern stuff this year, right? They're saying if the load continues to progress the way we think it's going to, you will eventually need it, but not right now. So, anyway, but yeah, I just wanted to show this map.
I guess I would kind of finish off this part of it with a repetition of my note of concern here. And that is whether or not there's duplication of effort between the 345 and the 765s, especially if there are step downs from the 765s, and given the capability for it to deliver arithmetically more power than you have with the 345s. And I just hope in the planning process there that they can explain, and we will give them the chance to do so, how this isn't a potential duplication of effort. And because in that final configuration of what the notices to construct actually look like, we're talking about significant impact to one heck of a lot of landowners in this state, and that's just a big concern. I think I'm repeating something that we all share here, no doubt. But wow.
Yeah, I hear you. I do.
I think I've taken us down that rabbit hole more than once here, and I'll back away and we can move on.
When you think about, and to me, what makes sense, and absolutely, we need to hear it from the people that are actually planning this system. But when you think about the fact that one of these lines can move 6 345 kVs worth of power, once it steps down, I mean, it's a lot of power, right? You've got to have somewhere for all that power to go once it steps down. And I mean, that is why they're gonna tell you it. If we didn't have those other 345 kV lines in the model, this would have just produced, more of those, right? So, I mean, one thing that we've determined over the years for sure, like for instance, we asked the same question because the Wolf Creek to Blackberry line is a 345 kV line in a relatively similar place on the system, but that line was already baked into all the modeling that created the the Buffalo Flats to Delaware line, right? And I think we will see that same situation with these, sure.
All right, thank you.
Oh, yeah, absolutely. Oh, there's one last thing. I can't believe I remembered it. This is an interesting thing as well, you guys, is the energy losses. And this is something that that I wrote down last week or earlier this week that really struck me is, you know, we think about this in terms of you can dispatch a generator, fire up, you know, we've got electrons moving down these lines, and then they just go from point A to point B, but there's losses that occur. And, you know, a 345 kV line is very efficient relative to moving that kind of power over something like 34.5 kV or 115 kV or 230. But the efficiency grows in order of magnitude with these larger transmission facilities. And so this was something that just really struck me. You think about what we were talking about earlier, which is that we are rapidly approaching a point where it's a near certainty that there will be 35,000 additional megawatts of demand on the transmission system in the next 3 or 4 years. If that amount of load was moving over 765 kV instead of 345, that's a 3% reduction in the losses that is experienced trying to move that power over those transmission lines. 3% of 35,000 megawatts is 1,050 megawatts. Just think about that. That is essentially the entire output. That's close to the entire output of Wolf Creek Nuclear Power Plant today, right? And so, I don't know. That was, to me, that was instructive, and I think it will be part of the equation, I'm sure, in terms of, you know, the additional capacity that's unlocked. That you don't have to build I mean, to rebuild Wolf Creek today would be, you know, I mean, that'd be a $15 billion investment. Okay, here's the remaining timeline. We're getting close. The report by the end of September will be finalized. It will be presented to Economic Studies Working Group and Transmission Working Group on September 25th. It will go to MOPSI on October 14th, 2026, and the board be presented to the board on November 17th, 2026. All right, we're gonna, I did not anticipate the ITP discussion to go that long, but I'm really glad it did because it's super important. And all of this care team stuff is still preliminary anyway, but we are going to do our best to wrap this up by noon. So this is just and commissioners, when you go back, if you spend more time on these slides, these care team updates in particular, you know, please let me know, reach out. We can have a conversation, but this is a pretty deep dive sort of graphic that shows basically the last 6 months of the care team efforts and initiative and where we are in this process. So August 24th, so this last Monday, I was in Chicago at the care team meeting, and all of the issues that you see, that meeting went from 7 a.m. until 5 p.m. And actually it ended a little before 5, but it was a full day for sure. But each of the issues that you see represented there on that gate 3 were evaluated in that meeting. And just, you know, stepping back a bit, I mean, at a high level, and I think that the bottom portion of that slide shows it well, is that, you know, what the purpose of CARE is to recommend a cost allocation framework for transmission facilities above 345 kV. So basically, what's coming out of the 24, 25, and 26 ITPs for everything that was greater than 345 kV. We are going to recommend a large load framework. We'll get into a little bit more detail about what that looks like in terms of that large load framework is likely to to focus on load interconnection, transmission upgrades that are driven by load interconnection studies, and who should be responsible for those network upgrades, what portion of that the large load customers should be responsible for. And remember, network upgrades are the transmission that benefits the whole system, but it's necessary. It's a little bit counterintuitive, because sometimes you'll do these load interconnection studies and they say, well, you have $200 million worth of facility level upgrades, and that is the stuff that only that customer is going to use, and that everywhere in the country that is directly assigned to the customer. But the way current cost allocation rules work, and the pro forma open access transmission tariff with at FERC and all of the open access transmission tariffs, if load is interconnecting to the system, but it creates the need for a network upgrade that benefits the reliability and the economics of the entire system, that network upgrade gets paid for by everybody, not just that customer. But there is a real question right now about how network upgrades should be cost allocated, and whether with the addition of all of this new large load, we need to reevaluate a change in how those that cost allocation is being considered. And so this bottom graphic shows it well. We're going to recommend a change in the cost allocation framework, potential a whole suite of reforms associated with the large load processes in SPP, an adjustment mechanism, which is basically saying, okay, if we do change cost allocation, what's the process going to be to make sure that we got it right and that there are no major losers and or winners. And then there has already been a recommendation to increase the threshold of projects from a 1.0 benefit cost ratio to 1.25. Ultimately, this is all, we're just a few meetings away from the final votes and the final recommendations. Now, something that's important to remember is this is a cross-functional leadership team with cost allocation working group members, RSC members, board members, and other members of different stakeholders throughout SPP, stakeholder organizations. But ultimately, it's the regional state committee that has the authority to make these changes. And the board as well has to approve these changes. And so the last portion of what we are recommending is the implementation framework, which is exactly how do we accomplish this and move this through the working groups and through the RSC the first half of next year. This is sort of what I just talked about, just a little bit different way to present it. These are all of the different elements that CARE is evaluating right now. This CALL stands for cost allocation for large load. And just, you know, at real quickly, some of the reforms that are being contemplated are, as an example, instead of the 765 kV line, for instance, you know, anything above 345 kV today is cost allocated to the region based on the proportion of how much you use the transmission system on average across the year. There is a cost allocation reform being contemplated that would tie a portion of that cost allocation to the physical location of the towers of the lines, instead of just cost allocating it across the region. There's a lot of discussion occurring and a lot of analysis in terms of what does the different power flow modeling and the adjusted production costs that are generated by these projects, what is it demonstrating that in terms of benefit across the region, and should it be regionally allocated, or should there be a portion of those costs that are more directly assigned to the local area where the lines are being built? That is very much a big part of this conversation. Everything we talked about with load interconnection cost responsibility is sort of captured there within that graphic, and those are still the details that are being considered and evaluated right now. This is just a, you know, just a quick, a lot of the way that policy development has moved forward on through this care team is through an evaluation of surveys, and they will do surveys of the care team members. You get an opportunity to vote and explain your rationale in terms of, do you want to see these cost allocation reforms move forward in this fashion or not? 72% of the group made the determination that any large loads that were contemplated or planned for the 2024 and the 2025 ITP should not be part of the cost allocation reforms going forward. Now, that's not the same as saying that the transmission lines themselves that came out of 24 and 25 ITP shouldn't be evaluated. Those are going to be part of any potential cost allocation reforms. But the reason ultimately that this got that level of consensus is because by the time that the 2025 ITP became finalized and received notices to construct, there was no speculative load. There was no uncertainty with regard to the load that was going to be served by those transmission lines. A lot of the reforms that we are evaluating are based on ensuring that we are planning the transmission system for load that will actually show up. So we probably won't get enough time to get into this specifically, but one of the reforms that's actively being considered and will likely come out of this process is something called load materialization risk. And it would basically be a situation where, and this is what's required as well from FERC, just issued a 206 or show cause proceeding that would require SPP to address this issue, which is when you have very large customers that have expected load that's coming online in the next 3 to 5 years, or sooner, but you have to build the transmission system today. FERC is requiring SPP to insulate all existing customers from the risk that we build the transmission system and then the load doesn't show up. So what is being discussed is changing cost allocation to be not just based on how you use the system today, but how you told us you were likely to use the system. So we're talking about the possibility of tying cost allocation to the higher of your actual usage or your forecast usage. And so that's going to be a pretty important reform. 90% of the participants in the care team agree that large loads should be charged more than existing customers. This is what Chair French was alluding to before. It's very similar to the way that we've dealt with the large load power service tariff in Kansas, which is that, as you know, those a data center or another large load that comes to Kansas will pay about a 20% premium relative to a standard industrial customer for their service, and that extra revenue is ultimately what is used to improve affordability or to put downward pressure on rates in a rate case, in a rate setting process. This is another, I mentioned the possibility, some cost allocation changes, on top of the potential for changing cost allocation to be just based on region-wide, how you're using the transmission system. There's also, and we talked about that there may be a reform that some of the cost allocation is linked to the area, the deliverability area where the transmission exists. There's 80% support amongst the group to add an energy component to the cost allocation framework. That also is very much driven by the likelihood of these large computational loads entering the system. We've all heard that these customers, these data centers, they use power 85 or 90% of the time, all around the clock. And the idea is, and there's a lot of consensus, again, 80% of the group agrees that we don't want those customers to be able to avoid contributing to the cost allocation of the transmission system in the event that they're able to avoid the peaks entirely. And so we've said, look, well, maybe 50% of the cost allocation needs to be based on how much energy you draw down from the system over an entire year. and not just how you contribute to the peak of the transmission, that is likely to shift a significant amount of costs to those really high energy intensive users that are using power 8,760 hours a year. So that all of this kind of fits in together. Again, 80% support for linking load forecasts to cost allocation in order to ensure cost alignment between who's actually driving the need for the transmission versus how you're actually using it. A lot of this is just additional details that we've already talked about in terms of how we are currently evaluating the possibility of developing a separate charge for large load users, and how we're developing the potential for some of those reforms in terms of forecast, linking cost forecast and adding energy as well. All right, I really wanted to be done by noon, but these slides are too important to not talk about. So you guys bear with me here. This is why I ate breakfast this morning. Okay. What these slides do is they go to the really critical question of why the care team was formed in the first place and why we expressed an interest in being on the stakeholder group in the first place. So as part of the evaluation of potential cost allocation changes for above 345 kV lines, SPP staff has performed power flow modeling simulations, and they have performed adjusted production cost savings simulations on a representative portfolio of the 765 kV lines. Now, they could not do this based on the actual portfolio of the 2026 ITP, because this analysis takes months to complete, and they needed it to be done during the time frame of when the care team, the scope of the care team charter, really, it only lasts in 2026, and there is some discussion about extending it a few months into 2027. So what they did is they have performed all of this evaluation based on the proxy overlay that came out of the 2025 ITP last year. There's two different power flow. I'm going to switch back and forth real quick between these. There's two different power flow analyses that were done. One is called megawatt mile and one is called megawatt shift. Those terms are still not 100% familiar to me, but my understanding is essentially megawatt shift is just how power will flow to the other deliverability areas in the event that you experience an outage in one of the deliverability areas. Megawatt mile is basically with that megawatt shift, how many miles of transmission do those power flow effects actually occur in? And so the way that this analysis was done is the north deliverability area. What they did is and by the way, they are using the modeling that is producing the recommendations for the 2026 ITP. So they're using that model set. They put in a hypothetical 765 kV overlay throughout the entire region. They go in and they simulate removing those lines individually, each segment of 765 kV line throughout the entire northern portion of the deliverability area. And then they evaluate, okay, how did that change? How does power flow and redistribute into the other areas? So it's an evaluation of how the transmission system in one portion of the footprint can impact reliability in the other areas of the footprint. So what you see here is, on average, when they take these 765 kV lines out of the north, for instance, 28% of that impact is felt in the central area, and 5% of that impact is felt in the south. And then vice versa, if when they remove, they take out they outage one of the 765 kV lines in the south, well, 68% of that impact, that reliability impact, is maintained within the south deliverability area, but 18% of that impact is felt in the central and 14% in the north. And then likewise, if you take out a 765 kV line in the central deliverability area, you can see how that impacts the south and how that impacts the north. It's a very interesting analysis that shows, how interconnected the footprint really is, and especially the central part of the footprint, right? This is the megawatt shift evaluation. The other thing to think about it is, like right now, Kansas and Missouri are paying, well, we're not paying anything right now for the 765 kV lines in the south because they haven't been built yet. But if there was never another 765 kV line built anywhere in the footprint, then eventually we will start to pay, Kansas will pay 16.5%. When you add in Missouri as well, it's about 21 to 22% of the cost of transmission facilities that are being built in the south. What this power flow modeling is saying is it's not perfect. It's not right on top of it, but it's saying, look, you're experiencing between 16 to 18% of the improvement in reliability on your system from having those facilities in the south, right? So that's the way to interpret these results. It's very interesting. It also is showing that, look, if you take a line out in the central part of the United States, or in Kansas or Missouri, 40% of that impact is going to the south. 16% of that impact is going to the north. And so, you can also think of it as, well, we're paying about, and 44% of that impact stays in our region, but we're paying about 21 to 22% of the cost of those lines, right? And then this is just a summary that basically sums up what I just said. Now, this is that same analysis, but this is only an overlay. This contemplates only an overlay that is created for the south and the central region. So instead of the full overlay, this says, okay, well, at the end of this 2026 ITP, for instance, what will be the portfolio that will result 10 years from now? Or, this is anticipated to be in service by 2035. In 2035, if you outage one of those lines in the south, it'll have a 16% reliability impact on the central. According to the megawatt shift, it'll have 21% impact with the megawatt mile analysis, reliability analysis. So it also says, if we take out one of those 765 kV lines in the central region, 44% of that reliability impact will stay in the central region, but it will be distributed, you can see, pretty significantly to the south and to the central. And so this is one of the data sets that's being used to influence the recommendations, the arguments for cost allocation. This is a power flow analysis.
Yeah, Justin, I'll just say, I think I got way ahead of you like an hour ago, right? Because that slide was kind of exactly what I was referencing when I said, given what looks to be the overlay that they're going to recommend, we don't know for sure yet, but what preliminarily we think the overlay is going to be, it looks like that at least these reliability benefits on a percentage basis would actually line up pretty much okay with what we currently are allocated under the highway byway method. And so, I would say now that we see the overlay coming up into the central, we feel like we're probably going to be okay. whether we stick with current cost allocation or whether it changes. But what really you see here is the very, very, very limited benefits to the north under all these scenarios. And that's where the rub is now, is if the north thinks that this is where the build out ends, and if their load doesn't materialize in the north, nothing gets built to the north. I mean, they also could just say, gosh, guys, that's a lot of miles of 765 kV. It just seems like that's a very inefficient way to serve our load. We don't want it. I mean, there's lots of scenarios where maybe that north part doesn't get built. And I think they rightfully are saying, if this scenario on this slide is what we're left with, we're not saying we shouldn't pay anything, but, our full highway byway load ratio share might be enriching the central and the south under current highway byway. And I think Justin and I agree that is a fair criticism. So that I
Absolutely.
just got way ahead of you with that slide.
Yeah, it's okay. I mean, look, I know this is going too long, but it's just too important of a topic not to continue talking about it, right? We only do this once a quarter, so based on everything I've seen so far, I'm probably going to advocate. I mean, there is an opportunity for my mind to be changed between now and our next CARE meeting, but I'm probably going to advocate for a revision to cost allocation policy for above 345 kV lines that would be based on 50% based on where the location of the facilities are, and 50% based on load ratio share, which is basically how much do you use. And that would be split, that load ratio share would be split 50-50 between your contribution to 12 CP peaks and your contribution to annual energy production. The reason I say that is because, and I agree 100% that even if there were no changes in cost allocation, if it was a highway byway approach, the analysis is showing that the central region is not, as long as, okay, here's the key. If those 765 kV lines never came into Kansas and we never, and the portfolio development stops, which I don't think is going to happen, but if that happened, then you can see right here, I mean, it says the South portfolio outages are mostly limited to their own deliverability area if you don't connect it through a central EHV. And that is exactly what we've been saying with regard to those big 765 kV lines that are necessary for reliability purposes in the southwest portion of the system and the southeast portion of the system. And that's why I think it's a good change in cost allocation to say we ought to link at least some of the cost allocation should be linked to the physical location of the facilities, because it's a protection from a situation where the overlay never gets built into Kansas and we don't start to experience some of those benefits. And also I think the North will eventually buy into that type of a cost allocation approach, because they say, well, if the overlay never gets built into the North, at least half of the cost allocation is going to be based on where it's physically located in those other states. Now, there's a lot that has to occur between now and getting the regional state committee and the board to approve that cost allocation change and to get it approved through FERC. But based on what I've seen so far, I think that would be a just, reasonable cost allocation change that would, present, that would be roughly commensurate, meet the legal standard of roughly commensurate. And it's just because we do think that the portfolio will be extended into Kansas, and it will be, this sort of central and south, and maybe it stops from that point. Maybe the overlay does not go further north and it's just 345 kV and other issues. If that happens, what you can see, when you take a line out in the central portion of the subregion, 44% of that benefit of that reliability impact stays in our region, but we would be paying about 22 or 23% of the cost of that transmission under a pure load ratio share approach. So I don't know. It's interesting. This isn't the only analysis. The engineers at SPP are careful to point out that these are just snapshot results. It was based on the load that was in the study at the time. I guess the other thing I'll say real quick, and I'm glad I didn't forget this, is what this power flow analysis is showing us. And this is why I think I am going to recommend my particular vote on the care team. I think will be recommending a change to at least capture a 50% allocation based on physical location of the transmission. What the power flow analysis is showing us is that even for these big lines, when they're isolated, before you actually loop them in and put them, as part of the whole overlay, most of the benefits, both APC, adjusted production cost, and reliability benefits, are being felt locally, which is interesting. And it's different than the rationale that was used to support the current cost allocation that we have. The current cost allocation we have is all about the fact that the larger voltage class lines that produce benefits that are felt regionally throughout the entire region. And what we're seeing from the power flow analyses and from the adjusted production cost data is, well, maybe, but until you loop the whole thing together, then a lot of that benefit is being felt locally. And so it may also be that whatever cost allocation we recommend or changes, maybe it's only in the interim until you actually get the full loop built, and then it may make sense to convert back to full regional cost allocation. It's kind of a recommendation that reflects the reality and the concerns right now of the regulators in the region, which is that this portfolio has been developing south to north, and once it gets developed, the further north you are in that footprint, there's a reticence to pay for transmission that, at least at that time, is only benefiting those southern customers. That it's also important to remember, nobody's paying for the Phantom to Crossroads to Potter line today, right? That line's not even being constructed yet. It hasn't even been decided yet. All right, we've already seen this slide. This is how adjusted production costs are calculated. Basically, this is fuel costs, right? And this is not like speculation or mumbo jumbo. I mean, you can calculate adjusted production costs precisely if you know exactly what natural gas costs are going to be, how much load you're going to have, how often the wind's going to blow, how much solar there's going to be, et cetera. So you have to estimate some of those scenarios and do scenario analyses and different futures, but adjusted production costs in real life show up every 5 minutes through the integrated marketplace, and it affects how much your fuel and purchase power costs are. And as the chair mentioned, we have been fortunate in this central part of the United States. If you look at our retail rates compared to many other parts of this country, outside of the central part of the United States, a big difference is the fuel and purchase power costs that are flowing through to customers. In fact, that's about 80% of the difference that some of these big national organizations have attributed to the difference in the retail rates between, the rate advantage that we have in the central part of the United States relative to other places in this country. All right. Thankfully, we are getting really close to the end. This is that same type of an evaluation, but this is adjusted production costs. And this is saying it's the same thing. So if, this is saying if only the central and southern overlay get built, not the full overlay, then this adjusted production cost scenario says, about 16 to 17% of 16 to 17% of the fuel savings, the economic savings, inure to the central subregion. And but you can also see that if it's just the central and southern overlay, 80% of those adjusted production cost benefits go to the south. Now, the reliability benefits were a little more widespread than that, but the adjusted production cost savings, this is in my mind, in my opinion, this is evidence to support a potential change in cost allocation that links the cost allocation of these projects a little more closely to the areas that they're being built. And then this would be but this is interesting because the last one we were talking about just the central and the southern, and it shows that it's more localized. It doesn't come up into the central part of the United States quite as much, but when you evaluate it with the full overlay, it just shows you how much more regionalized everything gets. Now, the central part of the United States, the central region, not the central part of the United States, I'm sorry, the central deliverability area, Kansas and Missouri, now we're getting 30 to 33, 36% of these fuel cost savings. That if you make no change at all to cost allocation, then we would only be paying about 22% of that. So anyway, that's it. That's the longest one we've done so far. Everything else in the appendix is just is the RSC business meeting materials. I knew it would take a while. I didn't think we'd go for 2.5 hours. Apologies to.
You should have had lunch with your breakfast.
I know. Apologies to the commissioners and anybody that's sticking through this at home. There's obviously a lot going on right now at SPP, and it's it's really important stuff. So I won't apologize for going through that material in that kind of depth, but sorry it took so long.
Well, I accept your non-apology because no apology is necessary at all.
Right.
I thank you very much for the granularity of your presentation, and based upon your explanation, I would encourage you to go forward with your plans with respect to proposed reconsideration and changes of cost allocation. I think that's a big deal. And again, thank you. Thank you, Justin, for the overview. Time constraints. Anybody can check out of this anytime they want to, if they want to stick around and get the details they can. So I'm grateful for your willingness to provide detail. Thank you very much.
Thank you, Justin.
Yeah, thank both of you as well. And I mean, I think we got all the questions out as we were going, which is great. I kind of like to do it that way anyway. So, but look, there's a lot of information, obviously, in the slides I sent. Take a look at them. If you have any extra follow-ups or questions, obviously, you know how to reach me. And then, we're looking forward to SPP's presentation on September 8th as well. As we continue to get information, it's going to move pretty quickly here over the next couple of months. As we continue to get information, we'll share it. I'll make sure to keep everybody informed.
Appreciate it. Yeah.
Well, thank you, Justin. And I'll point out, I sit in on a lot of meetings that Justin sits in on, but Justin, I'm tuning in and sometimes I talk, but mostly I sit back. Justin is flying all over the country, going to these meetings. He is representing our commission and our state very well, very comprehensively. He is leading a lot of the discussions from my perspective and just doing a fantastic job. And this presentation is just the tip of what Justin is working on. I want to make sure that that's recognized. So thank you so much, Justin. We really do appreciate it.
Thank you.
All right. With that, we have come to the conclusion of everything noted on today's business meeting agenda. And so I would entertain a motion to adjourn.
Oh my gosh, I move that we adjourn.
Second.
Got a motion and a second to adjourn. All in favor, please vote aye.
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 Aye. We're adjourned. Thank you all. Take care.
Take
Take
care.
care.